Good morning, everyone. We are right on the market. I'm Eugene, and Roger Wright has joined us today. Good morning, Roger.
Good morning. Good morning to not only you, Eugene, but the folks that took the time to join us. We appreciate it.
Okay, and we're starting our experimental stream on January 29th, hoping it will become a habit to talk about market this way. Also, Nick is helping us with the chat moderation, but we expect everyone to be polite, so. And we encourage you to ask questions and make comments in the chat. Okay, Roger, I would like to add something before we begin our market discussion.
Well, obviously, this has been a very tough 2 or 3 years. Certainly, the financial situation for farmers is overall more severe now than what it has been since 2020, when corn traded down to $3 a bushel. And so we definitely need to pay more attention to risk management. It's not just trying to get a price that is near the top of the year's range. We've got to pay more attention to risk management and the tools to do that allow us to be more aggressive in selling at a price that we think is lower than near the top, but still keep us farming if the prices don't go higher, would be put options. And so we need every farmer in America to understand put options, because those are the tools to capture the extra profit if price goes unexpectedly higher. So put options is the tool that we're heavily promoting. We've always been a fan of put options, but we're more aggressively pushing the use of put options. So that's risk management, and use put options to capture the bonus rallies.
Okay, yeah, I agree with that. And you never know where market's gonna go or where it's gonna stop the move, so you have to be prepared for different situations. And let's talk about markets then. And while waiting for for guys to ask questions in chat, and I'll start. So we had a surprisingly bearish corn S&G report this January, and lawmakers denied us year-round E15 for now. China bought 20 million tons of beans and stopped. The carryover is bigger for corn and wheat than the previous years, not to mention politics, tariffs, military tensions. So how would be a reasonable approach to such markets, especially concerning different market situations for the farmers? Also, some will have bins full or empty. Me personally, I think that at least we can shop for base, right? But could there be something else?
Well, certainly when everybody needs to understand that when futures are down, usually basis is firmer, and when futures are up, basis is usually weaker. Not always. Nothing's 100% in this business, but so the opportunity now, especially with the snow cover and the corn belt, is to keep an eye on basis. Not just if you've got corn in the bin, beans in the bin, and I should say wheat in the bin. Keep an eye on basis, because if the futures rally, the basis is going to weaken. When the weather warms up and the snow melts, basis is probably going to weaken. So just because you set the basis doesn't mean you have to deliver it now. You can set the basis for February, March, April, May, June, July delivery, but be shopping for good basis. We've seen basis firm as much as 18 cents on soybeans just Monday. at Cargill's soybean crush plant in Sydney, Ohio. 5 cents in Des Moines, ADM's basis firmed there, and some of the ethanol plants in Iowa firmed their basis as much as 10 cents in the past week or so. So shop for basis, get that locked in. Futures have turned around. We can say technically everything but corn made a high for the year, a new high for the year yesterday, and corn made the highest trade since the January 12th report. So technically, it's looking a lot better. The dollar index has fallen out of bed the last 7 days, down about 3%, 3.5%. And 3.5% on $10 beans is 35 cents. So that makes our agriculture and all U.S. products considerably less expensive for foreign buyers. And te- the technical aspect of analysis is that when the markets are going up, more and more technical systems turn bullish. Okay, and there's 660 different technical systems, and every day that any market moves higher for another consecutive day, more of those 660 technical systems are going to turn bullish. And we got to realize speculators trade, the hedge funds, index funds, they trade technically. And it's, us farmer types trade fundamentally. And obviously, we've seen over the last 2 years, 2.5 years, that the market doesn't trade fundamentally anymore. And it's not that it always did before, but at least there was some common sense to it. If the fundamentals were bullish 6 months in a row, you knew eventually that sometime during that 6 month period, the futures price would increase. But that wasn't the case last year. We had everything bullish through January up until February 19th, and exports were great. Corn ethanol crush was great. Soybean crush was great. Um, Soybean exports were reasonable, and yet the high for the year um, was made on February 19th. Um, and it turned out to be a record export year for uh, soybean crush, record export year, excuse me, record soybean crush year, record ethanol crush year, record export year for corn. The carryover diminished throughout the year, and yet from February 19th on, the price of those commodities continued until they bottomed in August. And so we got to pay more attention to risk management. It'd been nice to sell everything on February 19th last year, but fundamentally, there was no reason to sell everything on February 19th last year.
Yep.
But so, you know, this all logarithm trading, which I really don't understand, but it's a different animal. And probably technicians probably don't even uh, pay that. How much trading is done from technical analysis using one's head to technical analysis using artificial intelligence? I don't know, but it's not going to be trading fundamentally. Fundamentals are important in the end, but between now and the end, it's going to be this technical trading and AI trading, and it's a new show in town. You know, and we can't muscle it our way. Um, so we need again more risk management in our marketing.
Yeah, I agree. And I guess most of those systems just include the fundamental numbers and they count it in. So, but you said that we can definitely should look for the basis. And what about the strategies that some merchandisers allow farmer to do, like including put options? Like, do you recommend that or not?
Yes. Yeah. We sent an email on November 1st. This was when corn was going up from the August lows. Soybeans are going up from the August lows. And November beans were 1106. And we suggested that farmers, from a risk management standpoint, sell um, beans at $11. Okay. Not that we thought that was a high, but that's someplace around break even. And if beans can continue to go up, we were recommending then buy $11 put when beans got to 12, if they got to 12. And if they went to 13, you buy a $12 put. And if they go to 14, you buy a $13 put. All right. And that, as it turned out, March beans peaked at I think it was 1172 or 73. New crop November beans peaked at 1131, and on November 17th, and it's been uh, downhill into the January S&D, and yeah, so we got some clients that got new crop beans sold 11. They got old crop beans sold 11 or a little better. And when beans got to 1034, and after that January 12th S&D, when corn was down 24 and a half cents, a lot of guys were thinking, I'm glad I got some corn sold,
Yeah,
glad I got some beans sold, but that still doesn't mean that they can't go back up. And I hope they do. If for all those folks that sold new crop beans at $11 or a little above, the best thing can happen to them is beans go to $15, and they can get the $11 put bought, the $12 put bought, $13 put bought, and then next August when November beans are down to $10 or less, each one of those puts is going to be worth one or two or three or $4, depending on the strike price, meaning the $12 put strike price. The $12 put means the strike price is
yeah,
12 bucks. Okay. And you're going to end up, I mean, if you make $4 on your puts and add that to $11 HTA price, you're looking at $15 HTA equivalent there. And so um, we we wish we'd had more people get them sold, but um, again, uh, if prices go up, substantially, we'll buy those puts, and some elevators, as Eugene said, will actually buy the puts for you. If you don't ask, the answer is always no. Go to your merchandisers and say, if I did an HTA and the price goes higher, I would like to buy a put option and attach it to the HTA. All these elevators, all these merchandisers will buy call options and attach it to an HTA. And a cash sale, they'll buy call options. HTAs, they'll buy call options. Forward contracts, they'll buy call options and attach them to it. And all we're asking is if they would buy put options and attach it to the HTA or the forward contract. And surprisingly, we have several merchandisers who will do that. And they'll charge a service fee that's a little expensive, 3-4 cents a bushel. Whereas you can do it, you can buy that option you have in futures account for 1.5 cents a bushel, but you have to put up the money. Now the beauty of it is, you buy an option, whether it's a put or a call, you never have a margin call. Okay. The reason you never have a margin call is because when you buy a $11 put, you have the right to sell soybean futures at 11, but not the obligation. And since you don't have the obligation to sell beans at $11 with an $11 put, beans can go to $20, and all it means is your $11 put's going to be worthless because nobody wants to sell beans at 11 if the market's at 20 or anything above 11. But if the bean futures are down at 9, everybody will want to sell beans at 11, and that put will be worth $2. So if you're talk to your merchandisers, see if they'll let you do that. And here's another thing. So 30 years ago, we didn't have very many ethanol plants. I had soybean crush plants here and there, but most of the grain moved through an elevator, mostly co-op elevators, but privately owned elevators too. All right, and then we can have the processing plants come into the community, and they have a better basis. They have because they obviously need to keep their crush plants running, and so the local co-op and privately owned elevator lost an awful lot of business. Now, think about this. So you go to that local co-op, the merchandiser, and you say, "Hey, um, I I would bring 100% of my grain through you if you would, one, do an HTA contract, two, uh, buy puts if I wanted to attach that HTA contract, and three, let me do alternate delivery direct to an ethanol plant or soybean crush plant." Now, if you're running an elevator that used to do 10 million bushels a year, and now you're only doing 1 million bushels a year because there's been 5 ethanol plants in the area built and a couple more soybean plants. And a guy comes to you and says, uh, you do an HCA, buy puts, and let me do alternate delivery. His mind's going to go, well, let's see, do an HCA contract, I'll charge him 4 cents a bushel. Buy a put, I'll charge him 4 cents a bushel. Alternate delivery, I'll charge him 4 cents a bushel. And so, as a merchandiser, he's sitting there thinking, gosh, I can make 12 cents a bushel and never have to handle the grain. I don't have to worry about it going out of condition. I don't have to store it. I don't have to hire people to take care of it. I just got to do the paperwork and provide the money for the hedge account. And fortunately, there's been a lot of these co-ops jump at that chance to do that. We had one in 1990 that bought 71,000 bushels of corn in 1989. And in 1990, they introduced this program of HCA, funding the puts, and allowed farmers alternate delivery. And they had, by August 1st, they had 2.3 million bushels of corn on the books. 0.3 million. And the year before they had, I think it was 79,000 bushels of corn. Okay. And these marketing tools, if the farmers understand them, make you a lot of money, give you a lot of flexibility. And so go talk to that private elevator or that co-op that's kind of been left in the dust because of all the processing plants go up, and talk to them, ask.
Yeah, and just about that, and we about that put option strategy. So we have a question from David, and he's asking, good morning, and when using your put option strategy, do you recommend to buy the same quantity of bushing at the each strike price as futures increase?
Yes. If if you did, for example, if you did an HTA on beans at $11 and you want to increase the value of that $11 contract if prices go higher. So when you get a chance to buy a $12 put for 20 cents, if that's kind of what we're recommending now. All right. So beans go to uh, high enough you can get an $11 put bought for 20 cents. That means futures are about 12. All right. And then, and that's as high as they go. So you got the $11 HTA and you got the $11 put bought for 20 cents. And then it goes, it's all downhill until the end of August. And November beans are at $9. Okay. So your $11 put is worth $2. Now, if you bought a put for every bushel you have on your HTA contract, you're going to add $1.80 a bushel to that HTA price on every bushel. So you paid 20 cents for it, you sell it for $2, you make $1.80 on the put, add $1.80 on the $11, and you got 1280 beans. But if you only do it on half of your beans, well, then you're going to be selling half of your HTA beans, and you're going to be selling half of your beans for 1280, and you're going to be selling the other half for $11. All right. So if your goal is to enhance the price on all of the beans you got your HTA on, you got to buy a put for all of them. Simple as that.
Yep, and you just have to probably money management, right? Just to have another round after each
Yeah.
increase,
Yeah.
and that could be
And
a problem, but it's manageable.
yeah, one thing about it is we never recommend you go to your banker and try to borrow money on a hedge line of credit to fund futures, because soon if you get into a severe drought or a huge rally and the margin calls are piling up, the banker will come to you at some point, or his boss will come to you at some point and say, hey, we got a drought out here, or we had hail, or we had a frost, or whatever, and we know we got a hedge line of credit, and we know you got another $200,000 you can use on this hedge line of credit. But because of the drought, you're not going to have any corn. Therefore, this hedge that you have is speculation because you don't have any corn to back it up. Therefore, we're not going to pay this $15,000 margin call today. All right. So don't even waste your time trying to get a hedge line of credit. You have to jump through more hoops than a monkey at a circus to get a hedge line of credit, and then you can't trust the bankers to be there when you need them most. But when you buy a put, there's never going to be a margin call, and you got a lot better chance of a banker loaning you money to buy puts than you do to do the future. So you do the HTA at the with your merchandiser, and if he won't do the puts, then you use your own money. And if that's not enough, you go to your banker and say, "Hey, beans are $16 a bushel. I can I can buy a $15 put for 20 cents. That gives me the right to sell beans at $15. And any banker will realize, if he's an ag person, will realize that selling beans, locking in a chance to sell beans at $15 is a no brainer. And you tell him, I want to borrow 20 cents a bushel. And he's got any brains at all, he'll fall over himself telling you, why don't you buy two puts? Okay. So it's a lot easier to get bankers to buy loan the money to buy puts than it is. And we don't even want you to talk to them about a hedge line of credit.
Yeah, okay. And just to conclude this topic on the options, what about the premium price programs that some merchandisers made available? Is it viable for anybody to use really? Is it a good thing? Just I believe that they just write a call option with the HTA, right?
Yeah, or cash sale. So here's the way it works. Cargill calls it their what do they call it? Premium option program, I think, or option premium. But what here's the way that works. So we had clients in 2022. We had July corn get to 828 on April 29th of 2022. We had December corn get to 766 on May 16th of 2022. All right. And so uh, guys had their 2021 corn crop, and they had a chance to sell corn, cash corn, for $7.50 to $8. Okay, there in late April and May, and we had some clients that sold contracted their cash corn from 2024 for 750 or so, and wrote had their merchandiser write, when you sell an option before you buy it, the technical correct term is that's called writing an option. All right, selling it before you buy it. Now everybody in the trade calls it selling an option, but when a farmer calls me and he says, I sold an option today, I go, did you sell an option to get out of the market, meaning you sold one that you already bought, or did you sell an option to get into the market? And they go, oh, well, I sold one to get out of the market, or he'll clarify it. So it makes a big difference. So corn was 750, and cash corn was 750 there in May of 2022, and a person could have the merchandiser write, meaning sell before they buy it, a December $7 call for 50 cents. Now, keep in mind, December corn was at 760 at that point. Okay. So they could sell that call for 50, 60 cents. And that means the buyer of that call was buying the right to buy December 2022 corn at $7. Now, how many of us would say, gosh, I don't want anybody paying me 50 cents to buy my corn at $7. Only an idiot would say that when the cost of production is $3.50, $4. Okay. And so we had clients sell a $7 call for $7 for 50 cents, and that merchandiser would take out 4 or 5 cents service fee and add 45 cents or whatever was left to the contracted price of the corn and pay that to the farmer on their old crop corn. They could also do an HTA on the new crop corn and also write a call and add 50 cents or 45 cents or 30 cents, depending on the strike price and how aggressive they wanted to be, uh, and add that to the new crop HTA contract. Now, here's the danger in that. So, I mean, you get the income, it's great. You get the income on the old crop corn, or you got it applied to the new crop HCA. That's great. But if if it's a $7 put, if futures are above $7 when that option expires, you're going to have a new HDA contract obligating you to deliver corn to that facility, to that merchandiser for $7. Okay. And and so here's what can happen. Corn gets to $8, and you're thinking, "Oh my goodness, it's July, it's $8, and that option probably going to be exercised." Well, that's not a big deal. I can make good money with $7. Okay, so you don't sell corn, and then when fall comes, corn $6, and the $7 call is not exercised because nobody wants to be buying corn at 7 when the market's at 6, and it's not so bad. You got 50 cents or whatever premium, and it's okay. But you need cash now. Prices are low. Everybody's strapped for cash. cash. And the temptation right now is to have your elevator sell those calls. So you sell a $5 December call, and it's, I don't know what it is, probably 15, 20 cents right now. So you get that money coming in and added to your old crop sales, great. But then this summer, if corn would get to 550 or 6, and you're thinking, man, that call might get exercised and commit me to deliver corn on an HCA at $5, so I don't dare contract corn, my new crop, at 550 or 6 or 7 or 8, because I may have to deliver corn at 5. Okay. And so this is not the best year. When prices are this low, this is not the best time to be writing call options that may turn into an HTA. However, if the difference between you farming next year and not farming next year is 20 or 30 or 40 cents a bushel that you could get from writing calls on old crop and or new crop, you need to go ahead and do that. All right. Now, if prices do go sky high, and of course you never know whether those options will get exercised, here's what you do. You come back and buy a magic put. Okay? Buy a put. All right? Because you may be obligated to deliver corn at $5. All right? But the market's at 6 and it's first week in July. And daggone well, the market may be $4 at harvest time. And it was $3.95 low on December corn in 2025, $3.85 low on December corn in 2024. And there's a darn good chance that corn's going to be substantially less than $5 a bushel, even if it is at $6 the first week in July. Okay. So you buy a put option. And if it goes up some more, you buy another put option. Okay, so now let's say you buy a $5 put, you buy a $6 put as corn goes up, and then in August corn's down to $4 a bushel, and you say, well, daggone it, my $5 call I wrote with my merchandiser last spring is not going to get exercised. And if it hadn't been for those puts, I'd be selling corn for $4 a bushel. But I did get a $5 put bought, and it's worth $1. And I did get a $6 put bought or a $5.50 put bought, and it's worth $1.50 or $2. And so you're still going to be able to be selling cash corn for a price above $5 probably, and certainly above break even. The key is this: if you enter into an option premium, whatever your merchandiser calls it, where he's writing a call option that may result in you getting a new HTA, but you'll never know until it's too late. And if prices get high enough, you'd say, gosh, if I hadn't written that call, I'd be contracting corn right now. That's when you go, hey, right on the market said, this is when I should be buying a call op or a put option. Okay. You go buy a put option as the first time that you think, gosh, if I hadn't written that call, I would be selling corn right now. Go buy a put option.
Okay.
And if corn goes up another 50 cents or so, you buy another put option. Same money, same number of bushels.
Yeah, okay. So those premium option contracts just not for everybody, but for those who just have a desperate financial situation, right? Mostly.
Yeah, in this year, or if you're completely comfortable with buying puts and you're going to have access to the money to get it done, then, and look, if corn gets to 5.5, 6, it's going to come back down. Okay, it will. And I want to add this. This is true, that in the long run, the average cost of production will equal the average price paid to the producer in a supply and demand market. So if the price of corn is above the cost of production or way above the cost of production, it will come back down. And if it's well below the cost of production, it will come back up. The question is, how low will it go before it goes back up, and when will it go back up? In the same way, if it's rallying, you know it's going to, if it's way above the cost of production, you know it's going to come back down. You just don't know how high it's going to go uh, and when the high is going to be made. But you do know that if it's above the cost of production, it's going to come back down. So uh, puts solves a lot of marketing problems. And one more thing, Eugene, I want to kick in there.
Okay.
If you have an order to, for example, buy an $11 November soybean put for 20 cents, and you put in an order to buy a $12 put for 20 cents and a $13 put for 20 cents and a $14 put for 20 cents, no matter when the high on beans is made, no matter whether it goes to $14, $15, $11, $12, those put options in that stair step up method are going to catch the high for the year. Okay, I get so excited about this I can't talk. If you're gonna buy a put within 40, 50, 60 cents of the high for the year. And then the market's going to turn and go down, and you're going to end up in most years, you're going to end up with a price equal to or higher than the high for the year. Uh, just real quick, in 2022, wheat was $8 a bushel in January. We told everybody to sell wheat, and then the war started in between Ukraine and Russia, and wheat went to 13.45, and all our clients had wheat sold at 8, and the price of wheat's $5 above it. Okay, so what do? We had them buy put options, and some of them bought $9 puts, and then wheat went up and they bought $10 puts. Some of them spent more money and bought, the first one was $10 and then bought a second one, an $11 put, and then and we bought September puts because wheat usually makes its low in late August, early September. Well, just before those September options expired, September wheat was down to 745. Now you can do the math. What's a $9 put worth when wheat's at 745? Yeah, what? $1.55. What's wheat? What's a $10 put worth when wheat's at 745? And you sell those two, subtract the cost that you paid for them, and you're adding $2.5, $3 to your HCA. And for those that spent a little bit more money and bought a $10 put and $11 put, and then when wheat was 745 in September, my gosh, think about that. An $11 put and wheat's at 745, you know, you're talking about more than $3 a bushel net profit on the $11 put, more than $2 a bushel profit on the $10 put, and you add that to the $8 HCA, and guess what? 8 plus 2 plus 3 is $13.
Yeah.
And the high for the year was like 13.35. And we had guys selling wheat for 13.50, 13.60, and they had contracted 100% or close to 100% of their expected production at $8. Okay. And so classic beautiful reaction to result for buying puts in a stair step up method when the market goes crazy.
I like to just to simplify things. I like to think about put options like an insurance. You pay some premium and then you can it can get executed or not, and it just covers your losses or something like that. So
Yeah, that's
um,
exactly right. It's insurance. You know, you get you buy a life insurance policy for 10 years. You know, you pay a premium for it. And if you die, son of a gun, you get to collect on your life insurance policy. But if you don't die, you say, shucks, well, that was a waste of money. Okay, daggone it. And so um, it's exactly what you said, Eugene. It's price insurance. Um,
So,
Actually, if you buy put, you actually want prices to go up before they go back down, so you can buy another put.
yep. And just to specify, how do we sell? Because David asks that when do you know when to sell those bought put options exactly?
Okay, well here's the beautiful thing about puts. How the puts are going to have maximum value when the futures price is at the bottom. Okay. Now, just think about this. How much time does the futures price usually spend near the bottom of the year? And how much time does it spend near the top? Okay. Well, everybody readily knows how hard it is to pick the top. And so, maybe one day, maybe 2 days, maybe 3 days. If you're lucky, 2 weeks near the top. But most years, the market will spend a month, month and a half, 3 months near the bottom. And so it goes down, goes down, goes down, goes down. And then in the case of corn and beans, they usually make their low in August. And then they just drop sideways, waiting on harvest to start, waiting on the USDA to come out and tell us, how big uh, they think the crop was and what the demand will be. And so the futures go down, make a new low, and you're thinking, well, I wonder if that's a low. But it's August yet. Harvest is still ahead of us. USDA hadn't reduced a bearish September report yet, or even a bearish October report yet. And so it chops sideways. And it will do that for a month, month and a half, 2 months. And about the third time that it goes down and makes a new low by 2 cents or gets within 2 cents of the previous low that was made 2 weeks ago. And it's now October. And pretty much every, knows what the crop's doing and this and that. And you go, well, this is the futures today is within 3 cents of the low we made in August or the low we made in September. Yields seem to be about as expected. Demand is strong. I think I'll go ahead and sell my put. And it's a lot easier to sell your puts to maximize their value near the bottom than it is to sell an HTA or sell a call. If you'd bought a call, a courage call, if you'd bought a courage call and you wanted to sell that, if when the price goes up, it's you got 1 or 2 days to do that if you're lucky, and but you got weeks, maybe months, to pick the low to sell the puts to maximize their value. Okay, did that
Yep.
make it clear? Your puts maximum value are going to be when the futures are as low as they're going to go. Okay.
Yeah, and usually it's before the harvest year,
Yeah.
somewhere around it.
Yeah. Yeah. Yeah.
Okay, let's take another question. It was from Dan, and he asked, uh, please talk about aviation fuel and the plans to use renewable fuel.
Well, this is kind of a topic that gets beat to death. Our whole problem with all that is the government bureaucracy. All right. And I wish I could say happy days are just around the corner, but unfortunately, they're not just around the corner. Um, Certainly, aviation fuel from soybean oil, aviation fuel from ethanol uh, is being done. It is being sold, but it is more expensive petroleum fuel. Now, 4 years ago in 2022, sustainable aviation fuel was like $7 a gallon, whereas petro aviation fuel was like $1.80 a gallon, $2 a gallon. Okay, but what was going on then? The green the green wave. Everybody, all the bureaucrats, free huggers, everybody, all the Democrats that are elected to manage the cities and the airport authorities. We got to save the environment, okay? And so landing fees at airports are based on, um, every plane that takes off and lands has to pay a fee to that airport authority. And so they were given the airports were given huge discounts on the landing fees and takeoff fees for those airplanes that were using sustainable aviation fuel or different percentages of sustainable aviation fuel that made it worth. They saved so much money on the landing and takeoff fees that they were willing to pay $7 a gallon for sustainable aviation fuel. And so at that time, 2022, we were thinking, okay, as we get the technology developed to more efficiently produce sustainable aviation fuel, the price is going to come down, and airlines will jump on it and buy it and whatnot. And and here we are 4 years later, and what's happened? Well, we are making more sustainable aviation fuel, uh, but the airlines are saying, nah, you know what? This green thing, the airport and landing fees, we don't get near the discount that we used to. And uh, municipalities need more money, more airports need more money, and so the discounted landing fees apparently have eroded away. They're still there for sustainable aviation fuel, but worse yet, the the advancement of the technology and the willingness to spend the money to construct aviation fuel manufacturing has slowed down. And we still can't get the government to tell us about 45Z. We don't know if ethanol made into sustainable aviation fuel is going to be eligible for the 45Z credits. And we don't even know what the 45Z credit amount will be because the bureaucrats have had that on their lap for 4 years and they still haven't made a decision. Trump said we're going to sit down and get on that in March and hope to have a decision by the end of the year. Well, what the heck? By the end of the year, what? Uh, somebody needs to be George Patton here and make a decision, and go with it. Um, there was a huge GEVO and GEVO's aviation fuel technology firm that's been on the forefront of this, and I think it was ADM started construction of a huge sustainable aviation fuel factory in East Central South Dakota, um, and it was going gangbusters. Um, and then South Dakota decided they were not going to participate in the carbon recapture program. They weren't going to allow the pipelines to be built. And so GEVO and ADM uh, slowed down the construction of that plant, and they I don't know what ADM did, but GEVO moved their primary construction operation to a plant in North Dakota to make sustainable aviation fuel, and so they lost about 2 or 3 years worth of time there. And I'm not being critical of South Dakota for saying, no, we're not going to put in these carbon capture pipelines. I'm just saying that's what happened. Okay. And so, and here again, here, 45Z was passed in 2021, and here we are, and still don't know what the 445Z credits are going to be. Sustainable aviation fuel is for real. It's going to happen, but we
It'll
may
take
be
time.
sitting here
Yeah.
5 years from now and still not know when it's going to be really a practical alternative to jet fuel,
Yeah.
petroleum based jet fuel.
Yeah, I agree with that. And actually, we have another question from Will about the put option again. So he asks, do you want this put options in the fall delivery months and not shorter dated puts? Uh,
I, yeah. The question when you buy a put to supplement your income on an HCA, or just when you want to maximize your profit from a put, you got to ask yourself, when is the low for the year going to be made? Okay, when's the low going to be made? And you got to buy a put that its life will extend a little bit beyond when you expect the low for the year to be made, or at least into that time frame when the low is going to be made. Now, if you buy, for example, if you buy a July put on corn or beans, and if let's say beans get $14 in May or early June, certainly buying a put then, buying a July or August soybean put's probably going to make you money because usually beans are in a downtrend late June and all through July. Okay. But will the low for the year be made? And before that July or August option expires.
Usually
Okay.
not.
Well, the August option expires in July. The July option expires in June. Probably not. Okay. But uh, but if you sell it, and whether you make money or you don't make money, you can always go buy a September put or November put. But just to keep it simple and remove the temptation to just to make it simple, we recommend folks buy a November put and on beans and December put on corn. Usually lows are made in late August to first part of September. But if the yields turn out to be better than expected, the lows are going to be made during harvest. In a case of corn, it could even be made into the latter part of November. Your December puts expire the third or fourth week in November. Your November bean puts expire the third or fourth week in October. And I hate to say third or fourth week, you got to look at your calendar. All these options expire on the last Friday of the month that precedes the futures contract. On the last Friday of the preceding month, the Friday that still has two trading days the next week. Okay. So you look at the calendar and you say, which Friday in October of 2026 has at least two trading days the next week? Okay. And so it's the last Friday in October that still has two trading days the next week. That's the day that November options will expire. For December options on, for example, on corn, it'll be the last week in November the last Friday in November that still has two trading days the next week. And you got to remember, you got Thanksgiving in there. Okay. So that, you got to pay this trading days, not calendar days, trading days. Of course, Thanksgiving is usually always on a Thursday, but so I say options expire the third or fourth Friday of every month. That's true, but it makes a difference. As I'm looking at a January calendar here, February options. See, I'm looking at calendar. So the last trading day, the last Friday in January is the 30th of January. Well, the 31st is the last day. That's a Saturday.
Yeah.
And so options, the February options are going to expire the Friday, the 23rd, because that's the last Friday in January, the preceding month of February, and that still has at least two business days
So
the next month.
answering about the specific question, so we usually just pick the some fall delivery months because the low is usually August, September. So that's the common strategy here, I guess,
Yeah,
right?
as a general rule, buy December puts on corn,
November.
November puts on soybeans. And again, especially corn, if it's a bigger crop than expected, you can have the low made in late November, even early December.
And for
Doesn't
wheat,
happen very often.
for wheat is
Wheat
September.
September,
Okay, September. Right.
always September puts.
Yep.
And just real quick, we harvest wheat from middle May in Texas to middle September in North Dakota, Alberta, Canada, Saskatchewan, and the thing of it is, and this is especially true in the Corn Belt, some farmers, they harvest their wheat, they don't like the basis, they don't like the price, and they got an empty corn bin or an empty soybean bin, and they put wheat in the bin, and they think, well, prices will get better when harvest is over. Well, they hang on to it, and they get to the 15th of August, and now every farmer in the Corn Belt that's got wheat in his bin and every grain elevator that's got wheat in their bins, they want to get rid of that wheat to make room for the corn and soybean harvest. And so usually the low for the year, the weakest basis and the low on futures is the last week in August or the first week of September, because everybody in the Corn Belt's trying to get their bins empty.
Mm-hmm.
And it's hard to find a wheat. Your basis on wheat is usually weaker in late August in the Corn Belt than it is at harvest time. Okay,
Okay.
it just is. All right. So
Uh,
September wheat puts on all three classes of wheat. November puts on beans and December puts on corn.
okay, that's the way. And we have a question from Mary, I believe. And good morning, Mary. And she asked, um, we've had a little run up in price recently, and will it continue up? And if so, what price are we looking for? Um, so supposedly just for the price in the whole crop, something like that.
Well, of course, the most dangerous thing a
We
market
don't
provides.
have a crystal ball for sure. Yeah.
Yeah, most dangerous thing is to give a price and a date. Okay, you can give a price but no date, or you can give a date but no price, and you're going to be a lot safer. But all I can say is the dollar index, the exchange rate of the dollar, has fallen out of bed the last 6, 7 days. And I don't know whether that's the main reason that corn, wheat, and beans have rallied here the past week. It's certainly part of it. Okay. Certainly, the cold weather is part of it, and it's going to be cold for the most part next week. And the snow's certainly not going to be melting for at least another 10, 12, 14 days, and no guarantee it's going to be melting then. But here's the thing about technical trading: when the market's going up, every day it goes up, more and more technical programs say, buy it, buy it. It's going to keep going up, keep going up. And so we've turned the technical picture bullish on corn, wheat, and beans. And you gotta, I mean, most people trade technically. So you can't say, those technicians don't know what they're doing. If their technical system that a guy truly believes in says buy it, he's going to buy it. Okay. And I had a client ask me Monday morning. He said, "Do you think wheat's going to do anything substantial in the next two months? I got wheat I need to sell, and it price is low. I don't want to sell it, but I got bills to pay. What do you think?" And I said, "Wheat's over. Too cheap. Uh, Winter kill may be an issue. Blah blah blah." Bottom line is, I said it should, but I'm not sure it would. And that was Monday morning. Okay. And I was leaning toward telling him, just go ahead and sell it. Okay. And then on Monday, wheat was up a bunch. I don't know. Was that the day it was up 12 or 13 cents? And then up again on Tuesday and up a little bit yesterday. And so I don't know. Wheat's probably soft red winter wheat's probably I don't know, up 20, 25 cents since Monday morning. And I was telling the guys, I don't know. I think, you're paying interest and blah, blah, blah. And this morning I told him, hey, the dollar's falling out of bed. The technical technicians are getting more and more bullish. Although wheat exports have been very good compared to a year ago, we still got way too much wheat. But I told him today, don't sell it yet. I said, hang on to it a little bit. He wants to get wheat to 567 because his basis is 67 cents, and so he'd like to net $5 on it. Well, okay, um, but just remember this, Mary. If you don't sell when the trend's going up, then you're going to be selling when the trend's down. All right. Now, which is better? And here's my philosophy on it. You get a nice rally, especially one if it's halfway, if it'll make your cash flow work. You sell the stuff unless it's something is just so outlandishly bullish. You sell it, and if it keeps going up, you buy puts in the stair step up method. Now, be honest with you, the seasonal, and we've developed a lot of respect for seasonal price trends. And I'm telling you, wheat, corn, beans, most years, the high for the year is made between the last week in April and the third week in June. Okay. And obviously, if it doesn't rain in Iowa in July, corn and beans are going to go higher. And that's when you buy the puts. So, uh, from a market standpoint, not from a cash flow standpoint, but from a marketing standpoint, I wouldn't be selling corn, wheat, or beans right now, but you get them sold no later than June 21st, because that's when the seasonal trend turns down. And we've developed a whole lot more respect for seasonal price trends in the last 6 years than in my case, I've been doing this since 1980. Seasonal trend was okay, seasonal trend turns lower. Okay. But this year's different. Okay. Well, every year's different. But usually, 9 out of 10 years, the price trend is exactly the same. And the price trend is going to peak on all three of these commodities uh, between last half of April, the last half of June. So I would wait to sell. Now, that's just from a market outlook. Market risk, how much risk can you afford? That's a different ballgame. What's your storage capacity? What's your labor capacity? How much money you got borrowed? Well, what are you paying on interest? Those are all the kind of things that you need to take into account. And we have Lance Donlin is our full service market advisor, and that's a service we provide. You can talk to Lance and work out a strategy to take all those things that are unique about your farm and match them up with what we think the market's going to do, and come up with a market plan that way.
Yep.
Did
And
I
of
answer
course,
that question, Eugene? Did I
yeah,
answer that right?
yeah, I
Okay.
think. And just to remind that we usually have a price target in our Wednesday report, just mid to short term perspective, and we say that our goal on corn is this and soybean is this. So you can rely on that. Obviously, we can be wrong, and just as everybody, and but at least we are honest at what we're thinking. And yeah, like with seasonal, every year can be exception, like we had last year, making the top in February, but that's a not thing. So and afterwards, the June was the breaking point when we got a bearish rally without a stop. So it works.
Just,
Um,
just one more comment, if I might. Last February 19th, corn exports were going at a record pace. Corn crush for ethanol was a record pace. Soybean crush was at a record pace. Soybean exports weren't terrible, okay? And the price had been in an uptrend since August. and March corn got to 504.5 on February 19th. Soybeans, I don't remember how high they got, but they were at the high on February 19th. Record crush. And guess what? It was all downhill till August. And yet we still ended up the year with a record soybean crush, a record corn crush, a record, I think the crush was record, but it was high. And certainly by far the biggest corn export year we ever had. The carryover was reduced from January, most of the months through the end of the year, and yet the price was in a downtrend. So,
Oh, well,
um,
we had a new president and we had politics and tariffs taken into account and somewhat make market chaos.
yeah,
So
and that was true. The whole world thought Trump's tariffs were going to destroy all the markets, and that's true. But I guess yeah, that probably had as much to do with it. But the fundamentals, what I'm saying is the technical picture and the fundamentals were all bullish on February 19th. But here again, the market makes the top when everything is bullish. Okay. And by the way, it makes the bottom when everything's bearish and people give up. And if you don't sell when the price is going up, you're going to be selling when the price goes down. So we recommend you sell when the price is going up. Be careful what time, but we're saying in that April, May, June. And if it keeps going up, buy put options and make the money on the way down you didn't make on the way up.
actually, we have another question about put strategy. So um, I'm not sure who exactly, but Brian, I guess, asks when we have a demand rally, the tail and high prices generally runs into the next year. How does this change your put strategy?
Uh, for the initial operation, initial step, it doesn't change it at all. Obviously, if corn gets $6 or $7 a bushel in May or June, we don't know, how high it's going to go. We don't know how long it's going to stay high, but I know what Brian's getting at. So let's say, well, let's just go back to the 2012. Okay, the 2012 drought started in late June. And the market, well, I should say it started in early June, but the market didn't start going up until very late June. All right. And it got on August 10th, it got December corn got to 849. That was the high for the year. All right. So if a person would have bought a $6 put and a 650 put and a $7 put and a 750 put, he could have bought all those puts for like 20 cents a bushel. And then by the time corn peaked at 849 on August 10th. All right, so in October, December corn bottomed at, I think it was 710, 705, something like that. Well, obviously, the 750 put had a little bit of profit in it, but the $7 put and the 650 and the six, they were worthless. All right, so what do you do? All right. Well, how many farmers can make money when corn's at $7? I think most farmers, especially in 2012, thought, I can produce a bushel of corn for $4 or less. So what was going to happen in 2013? More corn acres, blah blah blah, and so what do? If your 2012 puts expired worthless, you go buy 2013 puts. Why? Because the price was profitable. It was the end of when those options expired, the price was still profitable. And 2013 price was still profitable. December corn was over $6 a bushel in December of 2013. December corn was over $6 a bushel in December of 2012. Okay. So you go buy December 2013 put options. And what was the price of December corn in the fall of 2013? 410. All right. And so do the math, okay? You buy a $6 or $6.50, $7 December 2013 put, and price goes to $4, and that $6 put is worth $1.90. 650 puts worth 240. So that's what you do. As long as the price is above the cost of production, you keep buying puts. And just a little note there, we got a client in Hardin County, Ohio. He sold his net price for his 2012 corn was something like 808, and his net price for his 2013 corn was like 804. I don't remember exactly, but I remember I had gave him some bad advice in 2014 or 2015, and I kind of said, "Gosh, I'm sorry I missed that." And he said, "Oh, don't worry about that too much." I said, he said, "I'll cut you a lot of slack." I said, "Well, I appreciate that." And he'd been a client since the '88 drought. And I said, "Why are you going to cut me slack on that?" And he said, "Well," said, "I never told you this, but I sold all my corn in 2012 above $8." And he said the price, I think it was like 808. And I sold all my corn in 2013 for over $8, a little bit less than I did in 2012. He said, "So don't sweat the mistake." And and that's what using put options can do for you. Okay, that's what they can do for you.
And
Imagine
uh,
if you could sell all your corn for $8 2 years in a row. Oh my goodness. Oh my goodness.
I would like to add that from the money management standpoint, there's nothing magical about the strike prices that we, well, write down or the premium cost. You can just pick the different strike prices, pay less, like 10 cents for those, but obviously you will buy less put options, but it will less costly for you, so it can be changed. It can be
That's right.
adapted. Yep.
Yeah, you can vary what you pay for puts. You can vary how frequently you buy them. Like on corn, do you buy them every 20 cents up, every 40 cents up, every 50 cents up, or every dollar up if you got a runaway bull market? Um, and a lot of flexibility there. The bottom line is the more confident you are that the price is going to go down, the more money you should pay for a put option. Okay.
Yeah. And if your put options expire worthless at the fall, and that usually means that the price is well above the break even, so you'll have the cash flow, you'll have the money to just finance it, so it won't be a disaster, right?
That's right. That's right.
Okay. Um, yeah, I'll think that we have last question in the chat that we didn't answer, and I'll uh, take it for later. And we have another one from what we have previously, just to conclude. So we have seen a firmer basis in various areas due to the cold weather recently. And is it possible to grasp that firm basis without driving a semi in unoptimal road conditions at all, or not? What do you think?
Yeah, what you do now, I'll grant that if an ethanol plant is desperate for corn because nobody's hauling corn in this weather, their basis for next week delivery, this week delivery is going to be firmer than it will be for the middle of February or for March or whatever. But nonetheless, if the basis is remarkably firm now, check out what their basis is for February, late February, middle March, or even April. Okay, and it in most cases is going to be firmer um, for like March delivery than it normally would be because the base is firm now. In other words, they're emptying their storage space. They're having trouble getting corn or having trouble getting beans, and they're not going to raise the basis any more than they have to keep the mill running, and they're not going to raise their basis very much if they still got millions of bushels stored in house. Okay. But they're going to be using up their inventory and they know they need to replace that as well. So ask if you can, what your basis is going to be for, March or April or late February when you think the weather will be fit, you can haul. See what you can get there. And here's one more thing, Eugene. Always ask for a firmer basis than what they're offering. If they're offering 20 under for March delivery, you say, well, we I want you to give me 18 under. Okay. And most of the time they will they will give you something. I mean, ask for 4 cent firmer basis and most of the time you'll get you'll get a penny or two. And you can say, well, how about if I deliver it a week earlier? Or how about if I give you 40,000 bushels instead of 20,000 bushels? Those are the kind of things that you can get that. I had a client that he was 60 years old, new client. And I said, by the way, when you set basis, make sure you ask Cargill for a couple more cents. And he goes, oh, they won't do that. I said, just ask them, Bob. Just ask them. Okay. And a couple of days later, he called me back and he said, you know what? I asked Cargill to give me an extra 2 cents. And they said, okay. And he said, all I can think about is the hundreds of thousands of bushels that I've delivered over the last 40 years, and I could have had an extra 2 cents a bushel. He said, it makes me sick.
Yeah, I believe Lance has a handful of those stories when he negotiated a better basis for him or his clients, so it's
Yeah.
doable for sure. Okay, let's take a last one. I guess we've been doing for more than an hour already. We had Clint asking, I have been a subscriber long enough to remember when TechGuy's comments were a little more forward looking and not just a report of what happened that day. Can we go back to that? And maybe you just explain what's the perspective for the tech guy and etc.
Well, we were doing more forward looking, and we had we had reason. And in hindsight, I don't know if it was good or bad, but we decided to go to some technical projections for each day. 2 weeks ago, I asked the tech guy, quit doing that. Don't do the opening calls. Don't give daily highs and lows resistance and support. Go back and do more education and more longer term projection. So is that what this client was saying? He would like the more longer term
Yeah, I
projections from
believe
the
he
company.
was talking
Yeah,
about the old
yeah,
reports
yeah,
and
yeah.
yeah, we're trying different approach with that with tech guy stuff and uh, what I can say is that we lack the feedback on those reports that he was doing, so we don't know how exactly well good or bad are those been. And well, we encourage anybody everybody just to send us a note saying
Let us know. Yeah,
yeah,
absolutely, absolutely
that will help
on
a
that.
lot just to figure out
Now,
what you're looking for.
yeah, I noticed yesterday's tech guy comments were, he's pretty much bullish everything, which he's a technician and prices are going up for 2 weeks, and he's going to be bullish. I also
He's a true
caution
farmer in
you.
heart, like most of us, like always
Yeah,
bullish. Not
yeah.
always, but usually. And
Just remember, all the technical systems were bullish on February 19th a year ago, and that was the high for the year. Okay, so
yep.
just remember that.
And I like the recent report with charts from him, probably more than the opening calls, but maybe the guys will like it too. So let's see.
Yeah, but
Uh,
really, seriously, let us know how we can use the tech guide to your benefit, our clients' benefit on that.
I'd like to say that he's an expert in tech analysis, but maybe he just lacks the farmer's perspective and what you need, what you want to see. So that will help him to adjust those reports accordingly. So okay, let's end this, I guess, because that was the last one, I believe, from the questions that we had today. And I
Eugene,
enjoy.
do we got Lance? Has Lance joined us and Brian? Lance, if he's there, why introduce him? Okay.
Uh, yeah, Lance sent me a note saying that he was listening, and Brian too, and I believe they should be in the chat, and they can get a say hi, I guess. And like you said, Roger, Lance is a farmer himself, and he's doing full service. Mainly, that means he's explaining the markets and tailoring those market strategies to exact operations, and he's good at it. And you can always have a call with him and talk markets, discuss the perspective and etc. So give us a note. Um, Roger, do you have something to just conclude this stream? And I enjoyed it, and I think it was useful, and I hope guys see it this way too. And uh, I guess we just would like to repeat it some future, probably, I don't know, maybe in a month, maybe in a couple of weeks, and we still want to have some feedback, how you liked it, and send us an email or comment or whatever, right?
Yeah, let us know uh, when you'd like us to do it again, and or what topics you want to cover. We need more guidance from our clients so we know what they want. Now, listen to me. Everybody will see something and they'll say, "Well, gosh, I think this or that," but they don't tell anybody. Okay. My dad used to say, for every rat you see on the farm, there's 50 that you don't see. And what I've learned in this, for every person that has a question, okay, for every client that has a question, every farmer that has a question, there's at least 50 more that have the same question but won't speak. All right. So we need you to communicate with us. Uh, I mean, we'd be glad to do this once a week, especially here during the winter. But we don't want to waste your time. We don't want to waste our time. Let us know. Let us know what you want us to do with these broadcasts. Let us know what you want the tech guy to do. And keep in mind, we always know you want us to pick the high for the market, and we'll do the best we can
Yeah,
on that. But we need to be more. All of us need to be more risk uh, sensitive and pay attention to that. Okay,
yep.
so
Okay, thank you everybody for joining us today and for your time. And yeah, and we'd like to see you soon. So thank you and bye.
what email address should they use, Eugene?
Just the
To
usual
contact.
support at right on the rightonthemarket.com, and it's usually just on the bottom of our every report, and you just click there and just send us a note, and we
Okay.
always answer those, and either privately or in the mailing. So uh, the communication line is open.
All right. Good deal. Good
Okay,
deal.
thank you, Roger.
Thanks a lot, folks.
Thank you,
Thank
folks.
you, Eugene.
Thank you. See you. Bye, guys.